Martin, I find talking to you fascinating because you have a unique macro and micro perspective on the housing market. And by that, I mean your understanding of the bigger picture, both globally and nationally, is constantly informed by your qualitative research, which delves into what property owners are actually thinking. And I'm particularly interested in your surveys in what they're telling us at the moment about mortgage stress. Is it on the increase?
The short answer is yes. Our surveys show quite a lot of information about mortgage stress, rental stress, and property investor stress, and they're all unfortunately rising. If you like, I can take you through just some of the key findings.
Please do.
Okay. Well, look, I thought I'd start with this picture, right? Because this gives me a bit of a sense of how I think people are feeling at the moment, hanging on by their fingernails, right?
I shouldn't laugh when I see that, but it's so typical of you to find a graphic like that.
Well, you know, it just seems totally appropriate at the moment. And look, the number one question I'm getting at the moment is, what do I think home prices will do in my postcode? So people are getting twitchy about worrying about what prices are going to do. And I keep saying to them, you know, you can't look high level, you've got to go granular, but you also, that's an outcome, not an input, right? So to understand the input, you've actually got to look at data. And that's what we do. So essentially, this is just a quick run through of, we survey households, we put a lot of information into our what I call our core market model, and we pull information out. And this is what we're going to share today. And perhaps we'll do it on an ongoing basis, because I think this is a really important conversation about what's going on. Absolutely. And just give you a bit of a flavor of how that runs. We can pull mortgage stress data out, price trajectory data, buying and selling intentions from the surveys, migration data and economic data, bang it into the core market model, overlay our scenarios, in other words, the broader economic situation, and we can drive that out into, at a postcode level, what's happening to home prices, right? So that's sort of how it works. But you've got to understand the inputs to understand the outputs. And just to give you a bit of a flavor how that works in practice, this is my price scenarios from now for New South Wales. And, you know, on a good case, 5% down over 12 months, a few more over the next couple of periods there. But on a worst case, perhaps 30 or 35%, average 21.5 across New South Wales. That's an average, right? But you've got to go granular, right? So that's what we're trying to get to now. But one of the other interesting issues is how people are feeling from a confidence perspective. Of financial confidence has gone backwards, right? So it peaked up after the COVID, it dropped, went up, now it's gone back down again. And that's driven by New South Wales and Victoria in particular. But what's fascinating is that mortgage stress, to answer your question specifically, has gone up. So we've now got the situation where 40.2% of households are in mortgage stress. Now that's cash flow basis, money in, money out. That's never been higher. And you can see how the trend line over time has gone up. I'm predicting it'll go higher still. And in fact, if you want to go granular on that, 40.2% is national. That translates to 1.5 million households in stress and about 100,000 risking default now. And interestingly, if you look at the percentage, it's Tasmania and the Northern Territories who have the highest percentage. But in terms of numbers, it's all about Victoria and Western Australia and New South Wales, right, as the big areas. Queensland's up there too. So it's building, and unfortunately, it's not looking very hopeful. Rental stress a bit the same. 34.5% of people renting, or 1.7 million, are in financial flow stress. New South Wales has 48.4 of them there, 35% in Victoria. So that's a big number. And the third dimension is investor stress. So this is property investors. 25% of property investors, or about 832,000 property investors, are now under the water when it comes to cash flow on their properties. So you put that together and you'd say that the stress information is signaling significant issues ahead.
So this is all very interesting stuff, and you can see the knock-on effect, obviously, you know, through rental stress, obviously is going to lead on to investor stress, for example. But what is the definition of mortgage stress?
Well, it's all three stresses have the same cash flow idea. So money in, money out, right? So in other words, each week or each month, how much is coming into a household, what's going out, including all of the standard things that they spend money on, and their mortgage or their rent. In terms of property investment, of course, it's the other way around. So then you're looking at the inputs by way of rent coming in and then all the payments out in terms of managing the investment property. So, but it's a cash flow base, because frankly, that's the only way to understand what's going on, right? You've really got to get granular and see how households are actually dealing with money in, money out. And when they're underwater, they're in stress. If they're more than 10% underwater, then we put them in a separate category called severe stress. And unfortunately, we do have some people in severe stress as well.
And so obviously the next expectation from that is going to be distressed selling, and a lot of media and a lot of consternation and guesswork going on around that. Particularly that the opinion, and it's probably well founded, that a lot of this is being held at bay due to government and bank assistance. But what's your opinion on the real story? Because the thing is that this won't, like you say, about being granular. You've got to go and find this information out at a granular level, but then I would imagine it's not necessarily going to play out uniformly across the country. Would that be fair to say?
That's exactly right. And I showed you those price charts at the start, right? And that number one question. The point is every postcode is behaving differently, right? And so there's a different supply-demand equilibrium story. There's a different stress story in each postcode. But generally what you can say is that prices are looking more negative in Victoria, and that's partly because of the new lockdown. New South Wales is looking a bit wobbly, particularly units. Some of the other places looking a little less wobbly, but still a bit down. And even Western Australia, that was down, 22% from where it was previously, is still looking as that will go further. So yeah, and it goes back to my scenarios. If you think that the virus is going to get under control and the economy bounces back very quickly, then the falls will be very light. But if, as I do, I think it's going to take a lot longer, and CBA the other day said U-shaped recovery. The RBA is talking about unemployment over 10% at the end of this year and 7% in 2 years' time. That's not a significant recovery, and so if you factor all of those in, and the fact that property investors are not seeing any capital growth for their investment, and the flows of rents are easing up. Ross McEwen from NAB the other day said, there will be a number of people who are now in the situation where the best thing they should do is sell, simply because ahead it's going to get worse. So I thought that was quite interesting that a mainstream banker is now actually recognizing we have an issue.
It's quite interesting too, because of course, coming up in a couple of other interviews in this today, I'm interviewing Eliza Owen and also Ken Lardner, and we're specifically talking about inventory levels as a leading indicator for, where we can see prices falling in a more geographical sense. So, and I look forward to talking to you further in, every month. I think what we should do is catch up. Martin, you up for it?
Yeah, let's do it every month. What I'll do is I'll share you the high-level numbers, and then we'll, call out some of the developments. Hope I'm wrong. Let's hope that prices don't begin to slide. But my own view is people should be quite cautious at the moment.
Look, I certainly agree with you, and I think that we should always be cautious about property, because there's been so much sort of cavalier good nature and good fortune around it, but it's not necessarily borne out in the evidence. So look, really appreciate your time. Looking forward to catching up with you again next month. And up next we have Eliza Owen, where I will be talking about those key indicators.